Let's get across the market open now. And Josh Barker joining us from Barker Wealth. Good to see you on this Friday. Let's take a look first what happened overnight. Wall Street, the S&P 500, the NASDAQ, the Dow, all taking out records yet again. Is it all about the AI trade?
Well, yes and no. I think that it's really what's differentiating the US market from the Australian market. We've seen a pretty big gap between the two markets, especially of late. And I think that's fairly justified, like the longer the war and the tensions and obviously the oil price on the back of it impacts us a lot more than the US. So I think just the fact that a lot of our market cap specifically misses out on that. They've got probably a handful of companies that are really benefiting from that in a big way, but those just make up such a bigger component than maybe some of the smaller companies that we've got here on the ASX that are somewhat benefiting from that as well. So it's interesting. Like they are in a different rate cycle technically as well. They're basically looking at holding flat rates for the rest of this year, and next year is the current expectation. So, that's sort of a muted point. And then if the AI stuff continues, and that just goes from strength to strength, then I think, that's puts the US in a good position to just continue on. Whereas, we just don't have that exposure as much here in Australia.
So, what are you looking at locally then? How have you changed your portfolio? Certainly. Well, let's go back to when the conflict began.
Yeah.
How's your portfolio evolved?
Well, I think it's diversified a little bit more away from ASX shares. I think that the US market, as we've seen, it's been a lot stronger. The new companies coming on to the US market, I think, is a really significant factor. So last night they just came out with the news that Anthropic, the owner of Claude, has inked its last raising nearly $1 trillion in value. I've been talking to clients about how these companies that are going to list on the US market are essentially going to slot straight into the S&P 500. At that valuation, it's slotting into the top 10. So you've got OpenAI, you've got Anthropic, you've got SpaceX, all gearing up for IPOs. They're all sort of sitting just under the $1 trillion market cap range. So it could, very foreseeably be the case that soon we're talking about the Magnificent 10 with those three coming on. And they are just as strong, if not stronger from a growth point of view anyway, than those Mag 7 that, the market has relished for the last 5 or 10 years when it was, the FANG stocks prior to that. So, I just think that there's such a big difference between the US and the Australian market. So the Aussie dollar has favoured a swap from ASX shares into US shares as well. So you're getting a better exchange rate for doing that now. So I think that's been the main shift. Obviously, just your general diversification has continued into other asset classes. But if you're talking specifically equities, I think it's just more shifted from ASX to US holdings is really the way.
All right. In terms of how you're playing the Australian market, though, and obviously we don't have those AI companies, but I guess one way to play AI is through data centres.
Yeah.
What are you looking at there?
Yeah, well, I think that's where Australia. There's lots of great parts of the ASX, and I think that's one that Australia it can really shine in terms of that infrastructure. So we saw yesterday Centuria came out and said it's going to turn some empty offices in CBDs into data infrastructure. So I think that's a real highlighted example of the shift that's occurring into that more infrastructure, and that's they did mention NVIDIA's technology in that announcement too. So that's a clear example of ASX companies doing what they do well, which is building, benefiting from those AI companies such as NVIDIA. So I think those typical data centers like your NXT, I think is the most mature in the space. I think the fact that they've already built a lot of theirs, are still expanding, but compared to a few of the other data centers, or potentially the REITs that are entering the data centres. They're just in a position where they've planted the trees for this data centre stuff 5-10 years ago, and it does take that long to really get it going. So I think that's quite a strong position anyway.
Well, you take a look at that share price. It hasn't really offered shareholders much, has it?
No, and I think that's what I'm talking about. It takes a long time for this to really come through from an economical point of view. It's a big capital outlay up front, and that's kind of what we've seen. NXT's gone and done a lot of raisings over the last few years, so you're diluting the shares, and then they've gone and spent that money. But I think that those trees will start to pay fruits very soon.
What about the tech sector here?
Yeah.
Given obviously caught up in the SaaSpocalypse, are you looking at perhaps some of those stocks that have been hit hard as potential value?
Yes, but I think there's sort of obviously, as you can see from the sell-off, it's going to go one of two ways. The winners are going to come out and recover from here, and there will be some that get sold off and continue to go down. So, yeah, you really need a little bit more careful rather than just saying, okay, I'm just buying it because it's cheap. Xero is an interesting one, and I spoke about companies getting exposure to this AI in the US. They recently inked a deal with Claude or Anthropic to offer that technology within their software. And in terms of Australia, they've got a great foothold in the market, and that's expanding. Look, they're going overseas, but I think if you just take it on its merit in terms of being Australia's number one and dominating that market, almost a monopoly. There are a couple of other players, but almost a monopoly. It's one that is really still needed by a lot of businesses. There's certain ATO rules and regulations, STP components that you have to use Xero for. So I don't think that at this stage, and that could change, cyber security's the next one that's getting sold off because they've come out with a technology. So it is highly risky that these really big companies, come out with a technology that does, erase these software services companies. But for now, I think that it's really embedded in the market in here in Australia specifically.
It is struggling to get that foothold in the States though, because it's up against Intuit.
Yes, exactly. And there's different rules. There's different
state by state
reporting. Yeah, super complicated. Obviously, we have seen companies like GYG, which is a completely different business model, pull back from that US expansion because it is just so complicated. It's so there's countless examples of companies going into the US and it not working. From here in Australia to Milk, there's heaps of examples, and the risk is real. But I think we saw a positive move from GYG when it pulled back from entering the US, and that's because it's got such a good foothold here in Australia. So if they just bring it back and they focus in, so Xero have the ability to do that if need be, and I think just based on its Australian exposure, I think it looks good value at the moment.